Apple's had a huge part of the NASDAQ 100 from the bottom as well, at least from the low, Joe T. About 15% Apple's gain has accounted for the NASDAQ 100. You sold it in the Joe T at the end of January. Give me your thoughts on Apple today after this run. What are you advising people to do?
Own it personally. Understand that Joe T is actively managed, so we're studying momentum, and momentum for Apple at around 170 to 175 was kind of a swinging door. It swung down below it, and for the time being, for much of the quarter, it looked like that was the right move. Certainly with it at 178 and restoring above that level today, it doesn't look like that. But I would tell people to own Apple, and I think the performance of Apple over the last several weeks is indicative of the overall environment where I don't think we're afraid of the downside anymore. I don't think we're afraid of a significant break below the January and February lows. In fact, I think most collectively people view that as a tremendous opportunity, and I think that's exactly what Apple represents.
Yeah, I'm just curious. You know, when you make a move like that and you're worried about momentum, and you know your Joe T is so focused on quality, momentum. If that's a case study in why you don't trade it, and then why you add it and then you leave it, because just when you think it's not going to deliver at the pace that it did, it does.
Well, my response to that would be, number one, you're correct. And number two, all I could say is that at the end of April, we will have a rebalance and reconstitution, and we'll be revisiting all positions, of which Apple's one of them.
I mean, you could have done a mic drop after number one. You're correct. I was prepared for that. Didn't happen. Maybe next time. Maybe next time. Now, Rob Sechin, not only do you own Apple, this was an eyebrow raiser for me. You're tactically overweight. It's now 10% of your portfolio. 10% of your portfolio is Apple. That's a little concentrated, no?
I think that there's a little context required there, Scott.
By all means.
We run a lot of portfolios. It's 10% of our quality growth portfolio.
Okay.
So
it's still 10% of a portfolio, right? I mean, the historical rule would tell you that's a little heavy, no?
Well, it depends on how you run money. That's just one part of client portfolio.
Okay, hot shot.
We bought a little more last week. We had been underweight relative to the index. We went overweight last week. I would tell you that it scores unbelievably high in our quantamental screens. It's cash flow rich, fundamentally sound, not reliant on debt financing for future growth, which, you know, as we're tightening rates, you know, you want to make sure that companies aren't exposed to that. So why does the yield curve matter for Apple? It really doesn't. It generates a tremendous amount of free cash flow yield and growth of 30%, cash flow growth of 30% year on year. So listen, it's an incredibly high quality company. I would say that the decision that we made to, you know, add more to Apple in that specific portfolio was because of the quality of the name. And we felt we had an opportunity to buy it at a relatively attractive level, and that turned out to be true.
Well, you hear where I'm going, though, right? I mean, that is traditionally a pretty concentrated position when anything becomes 10% of your portfolio. You're a good manager. You've been doing this a while. You know what you're talking about. But, you know, there are legitimate questions that one could raise about that.
I would say of a portfolio, not the portfolio. The portfolio is a mosaic of much more than just that.
Okay. Well, I mean, we can quibble with
You're
the
not
words.
going to get me there, Scotty, today.
No, I mean, we can go semantics all you want. I mean, I think any portfolio that has a 10% weighting in one single stock is worthy of asking questions about. And that's what I'm doing. Because I don't know, Courtney, that we would necessarily recommend to people that you have 10% of a portfolio, not the A, in one single stock like Apple.
Well, Scott, thanks for having me back as always.
It's good to see you, Courtney.
And I don't like to disagree with you often. However, we'll just call this a pivot a little bit.
Okay.
But I do understand what Rob is saying. So at Loop Capital Markets, we cover large institutional investors as well as small, and we cover clients that trade quantitatively and value. So, Joe, I'm going to throw one your way in a second as well. But what Rob's saying is actually right. So depending on your strategy, you absolutely can have highly concentrated portfolios. And it's not that big of a risk to have a name such as Apple at 10% of a portfolio, considering it's the most widely held stock. I think it still is in the market right now. And so when you think about that name being 10% of a portfolio, especially one that might be a highly concentrated portfolio strategy, that's not a bad name to hold. And so, you know, and back to Joe's point as well, holding it in your personal portfolio, I do. And I absolutely love the name. I've held it, bought it, continued to add to the position. So